Glickman Retail Group, Real Estate Investment Advisory. Retail Market Research, Quarter 1, 2013. National Outlook. Mixed signs of recovery. Since the recession, most economic indicators are tracking at or below average relative to other recoveries. Economic indicators. Unemployment rate is at 7.5%, the lowest since December 2008, after April's increase of 176,000 private sector jobs on top of the loss of 11,000 government jobs. Most new jobs were added at the retail and business services, but still 12 million are unemployed and 8 million are classified as part-time employees. Consumer confidence improved, demand held up. While housing and auto sectors are accelerating after years of turmoil, major sectors such as manufacturing are still showing signs of trouble. Personal savings rate, 3.9%, up from 2.5% in 2012 and 1.5% in 2011. Inflation under control, but commodity prices still volatile. Consumer debt rose to a new high of $2.8 trillion in January, mostly due to school and auto loans. Corporate profits hit historic highs while wages continue to feel the squeeze. Corporate capital spending remains restrained. Banks willing to push out debt maturities of bad loans. Equity markets up from stronger corporate profits. DJIA reached 15,000 on May 3rd, its first new high since 2007. Risks remain U.S. fiscal policy, local government austerity, Eurozone, global QE, and artificial stimulus, geopolitical, Middle East, and more. Federal Reserve officials forecast the economy will grow by 2.5% in 2013 and 3.5% in 2014. And due to the mixed signs of this slow recovery, the Fed will likely keep federal fund rates near 0% until mid-2015. On the retail front, the influence of technology, demography, and economic conditions has created sweeping changes in where and how consumers shop. E-commerce now captures a greatly expanded role in retailer sales and strategies. New concepts, the need for local fulfillment centers, and retailers' expansion help counterbalance shrinking store counts and smaller footprints, and filling up big box store spaces that have been vacant for a long time. Most retailers remain focused on efficiencies. Forecasts for retail sales will increase 3.4% in 2013, down from the 4.2% growth in 2012. The food index reached a new high in August 2012 after the U.S. suffered its worst drought in 25 years. Retail sales grew 0.1% in January 2013 from December 2012, and 4.4% YOY. Online grew 15% in 2012 and expected to grow 9 to 12%, compared to 3.4% overall. New store growth is limited. New construction remains near record low levels and rent gains are still anemic. Lackluster improvement in vacancies. Mall vacancy rates declined by 30 basis points to 8.6% in December 2012. Strip mall vacancy rate was 10.7%, just 40 basis points off the high of 11.1% in 2011. Notable retail store openings. Rue 21 Inc., 122. Chipotle, 160. LA Fitness, 60. Trader Joe's, 54. Chico's FAS, 110. Tractor Supply, 91. Darden Restaurants, 129. Ross, 79. Dollar Tree, 295. Family Dollar, 446. Dollar General, 558. Aaron's Inc., 105. Walgreens, 255. Walmart, 95. Big Lots, 31. TJX, 143. Notable retailers closing stores. Blockbuster, 650. Christopher & Banks, 138. Delhaize Group, 97. Limited Brands, 96. Men's Warehouse, 31. OfficeMax, 23. Safeway, 37. Office Depot, 18. Radio Shack, 49. Foot Locker, 35. Rite Aid, 46. Kroger, 11. Macy's, 6. Capital markets. Favorable spreads relative to the bond market, low interest rates, and the revival of CMBS will facilitate a solid rise in retail transactions in 2013. Secondary and tertiary markets will capture greater deal flow aided by CMBS capital availability. A 200 basis point spread between primary and tertiary markets and larger investor allocations to value-add strategies will encourage deal flow. The year is off to a strong start with $72.8 billion of significant commercial property sales in quarter one, representing a 35% increase from a year earlier and the second highest quarterly volume post-recession. Greater diversity among lenders and falling interest rates helped fuel the investment markets in 2012. Competition among lenders is expected to intensify in 2013. CMBS financing, coupled with growing lending by regional local banks, has helped fuel two significant trends: increased investment activity among private buyers and the increased transaction activity in tertiary markets. Approximately 42% of all loans for retail properties in 2012 were originated for CMBS, much greater share than for other property types. National banks increased market share the most, and although many of those loans may end up in CMBS issues, the revival of lending among regional local banks is also significant. The volume of outstanding distress for retail loans declined 12% in 2012 to $26.1 billion. Workouts will accelerate in 2013. Retail transactions, strong rebounds in select markets, and a slowing of appreciation in markets where prices are nearing or past peak levels. One-off sales of retail properties totaled $6.2 billion in quarter one, up 9% YOY. Transactions involving strip centers also reflect a positive trend, up 20% YOY. Overall, cap rates for the retail sector were relatively unchanged in quarter one. Investment shifted to higher-yielding secondary markets. Prices for anchored centers and single-tenant properties are rising faster than for other retail property types. The Orlando-Kissimmee MSA is comprised of Lake, Orange, Osceola, and Seminole counties, and is home to many tourist attractions such as Disney World, Universal Studios, SeaWorld, and Kennedy Space Center, which make this city the #1 tourist destination in the world. MSA population, 2,171,360. Population growth estimate, 1.9%, the second highest in Florida. Unemployment, 6.6%. Employment growth estimate, 1.9%. Average HH income, $95,316, compared to $123,440 for the top metros in the U.S., according to Moody's. Orlando's economic recovery is strong overall. The Orlando Metropolitan Statistical Area reported a 6.6 unemployment rate for the last month, with 1.05 million workers employed in March. The unemployment rate was down from 7.2% in February and well below March's 2012's rate of 8.6%. The local recovery is led by strong traditional growth leaders such as tourism and construction. Housing is becoming a major strength for the metro area economy. Residential building permits awarded throughout 2012 were up 80.8%, and the median single-family home price for January was up 15.3%. Orlando remains dependent on its established sources of growth: tourism, housing, and population growth. As long as the national economy continues to progress, these segments of the local economy should expand as well. Orlando is investing in huge infrastructure projects that will dramatically reshape Central Florida over the next few years. The push into life science began in 2006 with the Lake Nona projects, one of the largest in the world with a biomedical park of over 7,000 acres. The state funded a new medical school for the University of Central Florida, followed by Sanford Burnham Medical Research Institute, MD Anderson Cancer Center, a new Veteran Affairs Medical Center, Nemours Children's Hospital, Valencia Community College, and more. Employment in the Lake Nona area is expected to reach 4,000 by year end. Mass transit officially broke ground this year with the Sunrail commuter rail system that will eventually connect 61 miles from DeLand to Poinciana. Future plans include connecting the rail to Orlando's International Airport, Lake Nona, International Drive Tourist Area, and Innovation Way towards UCF. The new Amway Arena opened in 2011, and construction also continues on the new Dr. Phillips Center for the Performing Arts. It is expected to be completed in April 2014. The Department of Transportation is working on plans to upgrade the I-4 highway with new flyovers, HOV, and toll lanes. Stabilization of the Orlando Community Neighborhood Shopping Center market is finally getting a foothold. Net absorption for 2012 as a whole was 325,000 square feet, alongside 361,000 square feet of newly completed construction. Respective new supply and net absorption totals for the fourth quarter were 254,000 in 3 projects and 287,000 square feet. The quarter's and the year's largest project, completing in November, was the 129,000 square foot Lakeside Village Shopping Center Neighborhood Center in southwest suburban Windermere. January 2013, with no new supply delivered, saw 42,000 square feet of positive absorption. Per the date of this report, meanwhile, 3 community neighborhood sector projects with a combined total of 192,600 square feet were under construction, and the 108,000 square foot third phase of Orlando Premium Outlets in southwest Orlando is scheduled for this October. Vacancy ended the latest quarter at the high rate of 13.7%, down 20 basis points from the quarter before. Rent growth reflects the high vacancy and slow improvement at $17.32 per square foot and $14.83 per square foot. The fourth quarter asking and effective average for this property segment were down 0.3% each for the year. 2013 is expected to bring the first instance of positive annual increases since 2007. Rent growth at close to 1% is expected, a welcome relief after 5 consecutive years of loss. A long trek remains, meanwhile, before the large losses suffered since then can be redeemed. Power Center vacancy at 8.4%. The fourth quarter average asking rent for local non-anchor Power Center space was $24.15 per square foot, up 2.5% from last quarter. Retail real estate investment dollar totals have been increasing annually over the past 3 years. At $366 million for 68 sales, the 2012 dollar volume was up 62.6% from the year before. This quarter, $100 million traded hands in 10 transactions. Average selling prices for the year was $149 per square foot, but this quarter, the average is at $55 per square foot. The 12-month rolling cap rate per the end of the latest quarter in Orlando and Tampa was lower, in Orlando at 7.6% and higher in Tampa at 10.4%. Median cap rate in Orlando is 8.1%, and in Tampa, median cap rate is 7.8%. Third quarter Power Center vacancy rates in Orlando and Tampa were at 8.4% and 5.9% respectively. The fourth quarter mean asking rent for local non-anchored Power Center space in Orlando and Tampa was $24.15 per square foot and $22.83 per square foot, respectively. The author, Sean Glickman, CCIM, Managing Director of the Glickman Retail Group, Director of Retail Investment Advisory at Coldwell Banker Commercial. Sean Glickman is a real estate strategic advisor and an investment sales expert. He specializes in the shopping center industry in Florida, has a global real estate investment and development background, and is considered to be one of the foremost experts in the retail real estate industry. Sean is a graduate of the Shopping Center University at Wharton School of the University of Pennsylvania, a member of the National Retail Group and the International Real Estate Council, ICSC, CCIM, CIPS, and ULI, and is the Director of Retail Investment Advisory Group for Coldwell Banker Commercial. Sean's primary focus is on helping clients create wealth through real estate investments. He provides consulting, underwriting, and investment strategy to the world's largest institutional retail owners, REITs, and developers such as Brixmor, Kimco Realty, Casto Lifestyle, Westgate Resorts, Lamar Companies, Poloni Development, Phoenicia Development, Northeast Companies, and more. He has relationships with most institutional, international, and local investment firms such as Rita Development, Weingarten, Equity One, Cole Capital, DDR, Woolbright, Kite Realty, Global Fund Investments, Star Poland, Gazit Galab, Bezer Group, Africa Israel, and many more. Sean has built his business as a leading retail real estate investment expert thanks to his business intelligence and as an accomplished investor developer for over 10 years, unparalleled market knowledge, and his analytical capabilities. His client's success is always his top priority. Visit us at www.glickmanretailgroup.com. We are experts in institutional-grade investment services. As your objective advisor, our primary focus is to help you make the most effective investment decisions. Working with our team, you will maximize the value of your assets and create wealth for you and your investors.